Very good. So good afternoon, everyone. My name is Mark Medema, the Managing Director of the Charter School Facility Center here at the National Alliance for Public Charter Schools. This afternoon, we want to thank you for joining us for a webinar on charter schools and the capital markets during a pandemic. Today's session, first of all, will be recorded. There are some slides that will also be available. I think they may already be up on our website soon. We'll have, at the very end, the very last slide, we'll have a listing of where you can go to find both the recording and the slides and other ways to stay in touch with the Charter School Facility Center. All attendees have been muted. If you have any questions, there is a menu bar in Zoom that has both a chat and a Q&A. If you have questions you'd like to be asked the panelists, please type them in the Q&A box. Any other administrative functions you can use the chat box for. So I think that's housekeeping for today. Today's session, we have a moderator. I'd like to introduce Liz Sweeney, and then she'll introduce the panelists and begin the webinar. Liz is the president of Nutshell Associates, a municipal advisor and financial consulting group, primarily in the credit markets. She is formerly with Standard & Poor's and has spent a considerable amount of time in the charter school sector over the last decade plus. So I'll turn it over to Liz, and she can introduce the panelists, go through the presentation, and sometime, probably in about 30 to 40 minutes, we'll open it up for Q&A. Thank you, Liz.
Great, thank you, Mark. Thank you for inviting me and for sponsoring this really wonderful opportunity to share with the charter school community what's happening in the capital markets and what it means for charter school operators. And so anybody who has moderated a panel before knows that the moderator gets the easy job, because all she has to do is convince outstanding panelists to come and join and share their insights and experience with the group. And so today my job has never been easier. So I'm delighted to introduce my panelists. Today I have Greg McKenna, who's a managing director and underwriter with BB&T Capital Markets, and he specializes in charter school financing. We have Kevin Quinn, who's principal and founder at Y River Group, and they're an independent financial advisory firm. And Kevin has long and broad experience in public finance with many charter school clients. And we have Laura Kozel, who's Vice President of Capital Finance at Rocketship Public Schools, and they operate 19 charter schools in 4 jurisdictions. So we have a number of topics we'd like to talk to you about today, starting with how the capital markets reacted to COVID-19, and what does that mean for charter schools? What does it mean for cost of capital, for access to capital? What does it mean for financial planning and capital projects? And what can charter schools do, and how can they best communicate with their stakeholders in this time? And of course, we want to address as many of your questions as we can. So I'll start off by setting the stage with a little bit about the capital markets reaction to COVID. And I won't go into this in a lot of detail because the panelists will, but to understand where the market is today, it really helps to understand a little bit about where we were. And so the pre-COVID environment, which was really, it feels like forever, but it was just about 6 weeks ago, was really a historically wonderful environment for borrowers. And so municipal borrowers across the credit spectrum were faced just an absolutely wonderful environment. And there's a lot of reasons for that. And we won't have time to go into all of them today. But the bottom line is there was a lot of demand for municipal bonds. And so that really extended all the way to the lower rated credits, to the non-investment grade and the non-rated credits. And that's really where the bulk of the charter sector sits. And so now, after seeing unprecedented disruption in the economy, and all of the revenue streams that municipal bonds rely on, investors have very, rationally, pulled back very sharply from the market and, sought safety in cash. And when they're staying in the markets, they are demanding greater return for the risk that they're taking. And so what that means, for charter schools is the cost of capital has gone up. But it might help, as you're pining for things to get back to, quote, normal, it might help to remember that the pre-COVID environment, it wasn't really normal. It was a historically, generationally outstanding environment for folks that were seeking access to capital. So just to give you a couple of quick visuals on that. So one of the ways that municipal, market participants measure the demand for municipal bonds is by tracking the amount of money that investors put into municipal bond funds or pull out of municipal bond funds on a regular basis. And so what you don't see here on the left side of the chart are those inflows and outflows. What you don't see is for 60 straight months, for 5 years leading up to March, every single month, money was flowing into municipal bond funds. And what does that mean? The portfolio managers have to put that money to work, and so they have to buy bonds. And that pushes prices up and yields down, and that was one of the factors that made the environment so favorable for borrowing. And you can see that, reversed in very dramatic ways, and those are historic withdrawals that you're seeing in that mid to late March timeframe. Seems to have settled down a bit, but the net result is that spike in rates that you see on the right-hand side of the chart. And so, municipal market participants often talk about the cost of capital as having two components, one being the benchmark rate that a very high-rated AAA municipal borrower would pay. And there are indexes that track that, and one of the best known is MMD. And so we're showing you here the 30-year MMD at just a couple of points in time that illustrate how much it changed, more than doubling in just about 12 days in the middle of March. And then it's come down a little bit, but it still remains higher than it was. And then the other component of the cost of borrowing, which you don't see here, is what we call the credit spreads. So if you're not a AAA, and most borrowers aren't, how much incremental cost are you going to pay based on the perception of your credit? And so the credit spreads have widened considerably in the last several weeks. So that's a double whammy for borrowers in the charter school space. Not only has that benchmark rate gone up, but those credit spreads above that have widened out. So just a couple of other quick visuals on the market's reaction and why does this matter for a charter school. Treasury yields, bastion, of course, Treasury is a bastion of safety in uncertain times. The Federal Reserve has made it very clear that they want rates to be low, and they've intervened in the markets, and there's great demand for the safety of treasuries. And so at every maturity, Treasury rates are lower now. Why does that matter? Well, most investment portfolios, whether they're for operations or endowment or for pensions, are going to have some component that's exposed to treasuries. And so the earnings power of those portfolios is now lower. And as you look at the equity markets, they've bounced back quite a bit from where they were at their low, but still, well below their highs. And so that can impact philanthropy. Most pensions are significantly exposed to global equities. And then the double whammy for pensions is for a public pension plan, a component of how you calculate the pension liability is an assumption around the expected return on assets. And as you see here, if treasury yields are down so much and the equity markets aren't returning as much, there's going to be pressure from the actuaries to lower that assumption, which will have the effect of raising the liability. So that's the double whammy for pensions. Not only are the asset values down, but the liability can rise, which ultimately will probably result in higher cost to contribute to those pension plans. So how are credit analysts looking at all of this? So credit analysts, as you know, sit at rating agencies, at banks, and wealth managers, and mutual funds. And for the most part, they really try to look through what they see as short-term phenomenon and try to look at the long-term, because most municipal bonds are long-term debt. And so for charter schools, normally the short term and the long term are pretty well aligned with each other. But what they're seeing here is more divergence than probably they've ever seen before between the short term and the long term. And that's true across all of the public finance space. But they're really seeing a pretty good short-term story for charter schools, that they haven't seen dramatic changes in revenues and expenses. State aid is continuing to flow for now. They haven't, noted any changes in charters and authorizer relationships. And so this is really a very good story. If you think about some of the other public finance sectors where they rely on revenue streams from things like transportation or higher education, healthcare, even state and local governments, the charter school sector actually has a very good short-term story to tell. And that is a story that I think should be told because as markets change quickly and as, analysts and portfolio managers, investors are rushing for the exits, they don't always have the time to really, dive into these nuances and research, all these distinctions. And so, if this is a good story, I think that should be told. Where they're really seeing the risk is on the longer term. And there's been a lot, in the press about state government deficits that will likely occur pretty quickly. And so that's really, it's on the state funding side where they're seeing the risk, and perhaps some local demographic changes as we come out of this. We don't know exactly what the structure of our economy will look like. So we haven't really seen downgrades from the rating agencies yet. S&P Global has a pretty robust book of ratings, over 300 charter schools. They, for example, now have a negative outlook on the charter school sector, as they do on every US public finance sector. And it's really about this long-term view, but they haven't downgraded any individual charter schools. I believe they had about a dozen charter schools that had positive outlooks, meaning they thought there were reasons to think that those ratings might go up over the next couple of years, and they no longer feel that way, and so they pulled those off of positive outlook, but they haven't actually downgraded anything yet. So with that as background, let's turn to the panelists, and Greg, I'll start with you. What are you seeing at BB&T in terms of the market's reaction, and what is it meaning for how is it translating for your charter school clients?
Okay, thank you, Liz, and thank you, Mark, as well, for organizing this webinar. What you're looking at here on this slide is, the spike that we've seen in the rates, and really it's a liquidity-driven spike. And what does liquidity-driven mean? I hearken back to my finance professor explaining what liquidity was. Liquidity is essentially like oxygen. You really don't notice it until you don't have it. So the longer that goes on, the worse it gets. And I think what happened, prior to March of this year, we had, as Liz had said, a generational low yields, money flowing into the sector, far more money than there were bonds for buyers. Many deals were oversubscribed, meaning we had more orders than bonds. The inverse of that has happened. Now you have a market that's dislocated, where you had, during the month of March, many investors looking to sell bonds, and not really many investors there, leading to the spike in rates. So what that means to a charter school is, the cost of borrowing is going to go up. And if you see on the left-hand side, kind of the impact that it's had is, money has come out of the sector, over $40 billion. The rates have spiked. This index is where your bonds price off of that. So they price off of a spread. I think we talked about that a little bit earlier. 1%, 2%, 3%, above that was what that would have been prior to that. And now those spreads have widened, and it's gotten worse for the non-rated clients that have looking to do bond deals. So there has been some activity out there, but it has been for higher rated credits. But the volume has dropped off, not only in charter schools, but across the entire capital markets. It is starting to find its new level. I think the concept of a new normal is what everybody's going to have to get used to as it relates to anything and everything, I think, as we move through this. But really what's happened in the span of 6 to 8 weeks is what was a borrower's market is now an investor's market. So now if we move to the next slide, what does that mean to a charter school? And in this chart here, you can see kind of a sample of, this is a non-rated school. If you needed $20 million for your project, what did you have to do prior to COVID-19? You borrowed about $20.8 million. You funded a debt service reserve, you had some costs. And when bond issues get sold, they generally get sold with a 10, 20, and a 30-year maturity. So you see the rates there, the yields there, and an average spread in this instance was plus 218 basis points. That's equivalent to 2.18% over the MMD spread that was on the previous page. So what did that mean to you on a monthly basis? It meant your payment was $111,000. On an annual basis, you paid a little more than $1.3 million, and you paid $19.3 million in interest, and over the life of it, principal and interest, you paid about $40 million. Now, if you come over to where the market has been recently, you can see the dramatic increase in essentially everything. And the change on the far right-hand column is what's the difference between where we are now and where we were before COVID-19. So in this example, you need to borrow close to $2 million more to end up with the same $20 million project. And you see how everything kind of has gone up. The rates have gone up 1.5% or more. But if you get down to your monthly payments, you look at it on a monthly basis. On a $20 million issue, your monthly payment would now go up close to $20,000 more per month, over $244,000 a year, and $5.4 million over 30 years of extra interest. And then including the additional money that you borrow, it's going to be about $7.3 million. So that's how quickly it has changed. I think back to the 2008 and 2009 crisis that we had. This is bad, but this is much better than what it was 2008 and 9. Those deals in 2008 and 9, some deals had 7% coupons or 8% coupons, which would even make this chart even more dramatic. So it is a tough time, but the bond market still does provide 100% financing and long-term capital, and it is still a a place to get a transaction done. But it is now more expensive than what it was less than 60 days ago. So if you take a look onto our next slide here, I do want the participants to know that the markets are still open. The market is open. People are interested in looking, the investors, the analysts are interested in looking at transactions, but now it's at a different price point. So we're going to have to kind of reset expectations. If you meet anybody who did a bond issue last year and they tell you what the rates were, that's great for them, but there's kind of a new normal. We kind of all have to reset our expectations. The credit ratings are now going to be more important. You can, I think Liz alluded to the low investment grade credit rating and even high non-investment grade credit ratings. Those are still going to carry more value in this market than they would have 4 or 5 months ago. So if you can get a credit rating, it's going to be certainly worth your while to lower your costs on the coupon and the yield. So another thing is everything is going to be driven by the credit fundamentals in a transaction. Now it's going to be what is the strength of the school, strength of the management team, the funding levels in your state, retention list, all the different things that are listed here on this slide that is what's going to drive many of the decisions for these investors, because they now have money. There are more schools and borrowers looking for money, so they can be much more selective. They can also you're going to need to account for more time to get a transaction done. They will take a much deeper dive on your transaction. If you think about a transaction where you might be using funds for a construction project, they may want to know what is the lead time on any of these items, what is the ability of the contractor to complete on time and in budget, or I'm situated in Pennsylvania. The governor in Pennsylvania declared construction was non-essential, so many projects stopped. So it's been a 2-month delay. What type of things does that do to your project as you work your way through this, and think about what contingencies do I have to have in place when I'm thinking about our project. Other things that are going to be coming out of all of this is going to be the headline risk of certain states. It may be a hot spot because the state could be downgraded, or there was a lot of costs associated with the crisis that may impinge on future funding levels in the district. So the investors will also get a little bit more tighter on covenants and want to have more information rather than less information. So I think if you can just be prepared for that and manage that as you work through your project, you can still get a deal done, but it's going to be at higher levels and higher payments. And I think the strength of a credit rating will certainly pay dividends in this transaction.
Great, thanks, Greg. So Kevin, we just heard Greg talk about how the markets are still open. So public debt markets, you can still access capital there. It will be more difficult. It will perhaps take a bit longer, be a little more expensive. As you work with your clients, I know you look at a lot of different potential borrowing options. What are you talking about with your clients, and are you seeing any changes in the various types of borrowing options for charter schools?
Thank you, Liz. So yes, as Greg's noted, the interest rates on public offerings have increased significantly since the coronavirus arrived here in the United States. But even before this crisis, we've been encouraging our charter school clients to consider alternatives to public bonds. And up on the screen, we note in particular the options of bank purchase bonds or direct loans from banks, as well as financing by CDFIs. And both of those offer the potential under certain circumstances to provide a charter school a much lower cost of capital than would be the case with publicly offered bonds, albeit for not as long a term as one can expect with a publicly offered transaction. We've seen both the banks and CDFIs become progressively more knowledgeable and focused on the charter school sector. And if you go to the next page, Liz, we've provided this is very high level, but a comparative analysis of the relative cost of capital, terms and requirements associated with what I would characterize as the three principal financing alternatives that may be available to charter schools. And this isn't universally the case. Certainly schools that enjoy very strong finances would have ready access to any one of these three alternatives. Newer schools that aren't as strong financially might have somewhat more limited access, for instance, to the bank markets. But in any case, the key takeaway on this page is that there are other potential sources of capital as alternatives to a publicly offered transaction, and in many instances producing less expensive and more flexible outcomes. The major qualification with bank financings is that, again, banks usually require a well-established credit with the demonstrated ability to repay the debt that the charter might be considering incurring based on historic operations. So that's in distinct contrast to publicly offered bonds, where investors are willing to make an investment based on financial projections, for instance, of a school that's scaling operations or expecting substantial growth in enrollment over time. Banks typically won't finance projections, only proven operations. CDFIs, interestingly, fall somewhere in between that. They, in some instances, are amenable to a fully projections-based financing, although the majority of them, like banks, tend to be more focused on operating history and a school's ability to support the debt that's being proposed. In terms of dollar amounts, the public offerings are perhaps most appropriate for larger borrowings. They can certainly be done for, I think, cost efficiently for financings down to about 10 million, but one typically sees public offerings being done for financing amounts in excess of 20 million. I mean, in contrast, bank financing works well for amounts ranging from 5 to 20, sometimes, larger amounts, but we typically see bank financings in the $5 to $20 million range. CDFIs historically have been a source of financings for very small amounts of loans, and they've been super flexible in terms of both providing senior secured as well as subordinate financing. And interestingly, over the past couple of years, we've seen a number of the CDFIs rolling out long-term financing alternatives that are providing very compelling options, versus where they were just a couple of years ago to publicly offered bonds. If you go to the next page, we think that the availability of these multiple financing alternatives and the new challenges posed by the pandemic call for more robust planning for financing needs, along with all the traditional credit challenges that charters face in pursuing financing. They now need to address how they plan to operate in this new normal environment and how their per pupil funding and charitable support may be affected going forward. All that should be reflected in a very robust set of financial projections that demonstrate the school's ability to support any debt that it proposes to incur. So finally, and this is on the right side of this chart, we encourage our charter school clients to cast a wide net when they're pursuing financing. The best way to do that is through a competitive solicitation of all viable financing alternatives. And that approach comes with several benefits. It helps assure that the school receives the most compelling and competitive financing offers. It enables the school to compare the relative cost in terms of each financing alternative. And it helps the school formulate its preferred plan of finance while preserving backup alternatives if changing circumstances undermine the feasibility of that preferred alternative. So with that, Liz, I'll turn it back to you.
Great, thank you, Kevin. So Laura, tell us more about what Rocketship is doing. How is all this impacting your operations? Are you seeing any significant changes in revenues or expenses? how is this impacting your capital planning or construction underway, your debt plans? Basically, tell us everything.
Thank you, Liz. And I think, it is true that everything that an operator thinks about has been affected by this. So let me start first with talking about operations, and then we'll talk about capital. I think the first wave of change was obviously distance learning for operators, trying to figure out how to do that, staying connected to families. For many operators in this industry, we serve a low-income population that may not have access to the hardware or the broadband service that they needed to do successful distance learning. So we tried to tackle those as best we could. We still don't have 100% participation by our students, but we have a pretty high percentage, and we're working towards getting 100%. So we had to purchase and deploy more Chromebooks and laptops. We had to make sure that our IT service provider could help our families get access to broadband service. That was the first wave. And then I think in the second wave, we're thinking more about how do we keep our students from not only the typical summer slide on academic achievement, but I think the slide for students is probably going to be a little deeper in this environment. So preparing for our data folks in-house and our achievement directors to figure out the best way to deploy some additional internal testing to get a new baseline for our kids. And I think the third wave is really that we've sort of become almost a quasi-social service agency for our families, and talking about the wraparound services that we can help them with during this time. It's been difficult for some families to just manage their own personal affairs in addition to trying to help their kids learn at home. So we've continued some things that are impacting our expenses as well. We've continued to serve meals to the community. So all the money that we were spending on serving meals at the school are now being served to the community. And there are a host of other things that we're trying to do for the families. And the reason that I talk about that is I think these are all important things that our investors and our funders want to know. Very quickly after the California stay-at-home order was issued and the schools were all closed, we started to get inquiries from lenders and our funders about, what are you doing? So one of the things that we've tried to do on the finance team is to complete a narrative summary of all the things that Rocketship is doing. I think it will be important not only for new credit, I think it's also important for the lenders that are servicing our existing debt, that we keep everyone informed about what we're doing. And the why of that is because we're trying to preserve enrollment. At the end of the day, we're all running a business. We all have to pay our bills. We have to make sure our debt stays on track. So we need to make sure those kids come back. The best way to do that is to roll out the types of systems that they need to be successful to the best of our ability. Make sure that we write the story about how we're doing that, because at some point, to Greg and Kevin's comments, we're going to get underwritten again. And these risks are all going to be discussed and inquired about, because nobody really knows if this is coming back or we could have another event in the future. So I think the deeper credit analysis is in our future for everyone, and we will need to have all of this codified. From a capital standpoint, I think we're doing largely what all the other operators are doing, and thinking a lot about short-term credit needs in addition to the PPP program. for smaller organizations. We're also looking at multiple term sheets for lines of credit for our schools, and we've had some success there. And so the immediate need is to look to see where we can obtain access, even though we may not draw it immediately, access to short-term capital. We're also looking at our budgeting process. I think, you know, the expense line items that an operator has is they're going to adjust across the board. The non-comp expenses that we look at typically, I think we're going to have fewer maintenance expenses while our buildings are closed, obviously. But we're also going to have more expenses for the resources for our families for distance learning. We have been able to negotiate some reduced cost on our software maintenance contracts. We looked at all of our short-term contracts. We renegotiated them where we could to try to lower our expenses. And things that you don't normally ever have to think about, we are thinking about now. Even, you know, when your building is vacant, the insurance company probably has some exclusion language about a 60-day vacancy. And it started to make us nervous that we have 17 vacant buildings around the country, and would we be able to file claims? So interestingly enough, the insurance industry considers our buildings to be unoccupied and not vacant, and those definitions are very different. So, you know, we never thought about that before. Who could have anticipated that this would be something we'd have to be concerned about? But I think that's the kind of brainstorming we're doing. I'm sure it's the same for most operators. But the budgeting and the short-term capital needs are our focus right now on the finance team.
Great, thank you. So Mark, do you want to see if we have some questions in the Q&A box?
Yes, thanks, Liz. So everybody, that we have on your toolbar, you should have a Q&A box. You can ask questions in there. The first one is from Tina Smith, probably for Kevin. Is it possible that investors are now going to require additional compliance and covenant information given the increased risk in the market?
That's a great question, Mark. We're not seeing from investors or lenders greater rigor with respect to financial covenants or requirements with respect to their financing, but way higher degrees of rigor with respect to underwriting standards. So they haven't yet come back with greater restrictions on operations or tougher debt service coverage covenants or things of that nature, but they're being way more challenging in terms of the types of information that they're requiring, and especially with respect to reporting, operational reporting and projections. They're looking for highly detailed presentations that demonstrate that the schools thought through all of the their major revenue and expense drivers for purposes of providing a fair and reasonable assessment of what the future holds.
Great, thanks. Here's one for maybe Laura. This is from Steve Levy. Do charters typically buy business interruption insurance? Or do you know if you have business interruption insurance that might be able to be used for the COVID-19 expenses?
We do have business interruption coverage for, I think, 12 months. And we've talked about using that, but I think there may be some long-term impacts on premiums if we do that, obviously. I think we prefer to try to manage our way through this short-term capital problem with some short-term lines of credit. We've talked about the business interruption, but we haven't really decided to pull that trigger yet.
Okay, thanks. Greg, do you see any other or upcoming long-term risks in the market here as things might change and or stabilize?
Yes, I think one of the challenges with the whole pandemic is, we're just 6-8 weeks into this. It moved very quickly. It really caused a lot of problems, not only in the US, but globally. So there's going to be an impact on state governments, local governments, school district budgets. There will be pressure on those budgets in future years. There has been some support from the federal government, but there's going to be pressure, obviously, on all of these budgets. And certain states may be in worse shape than other states. You also now have political risk. It didn't really help the markets, I'm sure, that Mitch McConnell said he'd be in favor of states filing for bankruptcy. So we don't obviously want states filing for bankruptcy, but there's going to be pressure, and it's not going to be anything we know in the next 2 or 3 weeks. This is going to be in the next 12, 24, 36 months out. There will be pressure put on budgets. So
It's a good
You
point.
just
It just
kinda
reminds me,
have
we may
to,
end up having to do another one of these
send-
as soon as state budgets are released after July 1.
Right. I think some of our markets that we've talked to, there's going to be updates from the governors, whether it's in May or June, of what they think next year is going to look like. I think everybody's safe for the balance of this fiscal year through June 30, but the question marks start popping up in 21 and 22.
Thanks. There's another question. Joanna Bennick asks, maybe this is for Laura. If I'm looking to start a building project, would you advise waiting on this? Are you in that position, Laura?
We are. We're right now in design on 3 projects in 2 different regions. And it's a conversation we're having in real time this week and next week. I think there are so many variables depending on where you are located. A place like Washington, D.C., we're hearing that the K-12 education budget is likely just to be flat and not cut. Other places like Tennessee, we're expecting to have a pretty deep cut in funding over the next at least year, maybe 2. So those decisions have a lot to do with affordability. And we are right now running some sensitivity analyses that will give us the best case, base case, worst case, based on what we anticipate the funding will be, and how big our school enrollment is likely to be. And then we will make our final decision with our board. But it would be really hard right now unless you had some certainty about those 2 things. Is there enough transparency right now where you're at to know if your funding is going to continue? Do you have something that gives you a fair amount of predictability on enrollment so that you can assess the affordability of the project? And do you have, some funding available? I'm glad, Kevin, that you brought up the idea of some alternate funding. I think even Rocketship is looking at changing up our financing platform from strictly doing public offerings of long-term bonds to what does that look like if we went to a local bank that we have a relationship with or a CDFI that we have a relationship with and look at this as a 3 to 5 year financing window. So I think those probably are the 3 major considerations for figuring out if you can really move forward.
That reminded me, so you'll see on the slide for the audience on the slide here, we have the location of where the recording of this webinar will be in the slides. There is at that same place, we had a webinar a couple weeks ago on the impact of the coronavirus on construction. And one of the participants was talking about how pricing of land is going to shift dramatically. And so for those of you who are considering building projects, if you already own the land, not much to do. But if you're looking at land, there was some advice about the timing and how to play the market here as land values are going to change. We have another question for Kevin about, Laura talked about communicating with stakeholders. You talked about communicating with stakeholders. How important is it and who are those, and can you ever communicate enough, or what's the best way to communicate with everybody?
Sure. Well, I guess, Mark, they fall into two categories. One are the stakeholders that have I guess, a specific stake in outstanding debt of a school, and those might include a lender, bondholders if there's publicly traded bonds, as well as one or more of the credit rating agencies. And our perspective on that group is that you certainly want to be forthcoming and transparent with information, but the only thing worse than no information is useless information. And I think Laura hit it right on the head. It would be better to refrain from providing any information until it's based on reliable assumptions and guidance on issues like what per pupil revenues are going to look like in the coming year, how philanthropy is shaping up, how major cost drivers are being affected, and potentially adapting to the circumstances, and not communicate with those stakeholders until the school's got a very solid plan for the future nailed down. And of course, that's going to take a lot of planning, and it may be a number of months before any school would be in a position to provide valid and reliable information about what the future holds. The other constituency, of course, are internal stakeholders, and I think primarily of board members and certainly major benefactors of the school. And they're keen on being engaged and being helpful. And of course, and I don't envy Laura's lot having to do all of this planning and work to to address all these crazy variables that she now faces. But engaging them in that planning exercise is a healthy thing. It helps them and helps Laura provide her support in thinking through all these different scenarios and coming to some reasoned business judgments about how best to forge ahead.
Thanks. Maybe to Laura then, are there other ways you're thinking about being proactive with all of your financial institutions or construction properties?
Thank you, Mark, for that question. I think we're looking at it differently if it's existing credit versus future credit. And I know there are lots of lenders and underwriters on this call, so I might make everybody cringe here for just a moment. But I think we have to think on our existing debt about what kind of short-term relief is possible. Depends on your lender, depends on what kind of long-term debt you have. But the things that we're thinking about is short-term relief from liquidity covenants, short-term relief from debt service covenants, all those things that we're thinking about. It goes back to, kind of like when we finance a new school and we have to think about the ramp up. Ramping up all those things at the beginning of a new school's credit. It's like we're starting over with these schools. We think we have good predictability about how the kids are going to come back. We're trying to find as much information as we can about what's going to happen to the revenue side, but we probably will need a ramp up period of some sort for these covenants. And so I think we would negotiate differently now than we would have a year ago on those kinds of covenants. And I've been talking to our underwriters a lot lately. And I think the investors that have already invested in us, are interested in our long-term viability. And we're hoping that they will be flexible with us when we make our ask.
Great. Well, we're all for trying to make financial institutions squirm a little bit, so that's that'll be fun. So there's another question from the audience for maybe for Greg. states out, it might be a silly question, but if so, the investor market, if it's now an investor market, but liquidity is like oxygen. So somebody's listening to your finance professor. Do you think charter schools with higher rates of liquidity, what should they be doing? Is this a good time for them to take a risk?
Always a good time to take no. I just think one of the things I'd like to kind of revisit, on our example, the fundamentals will not change. The bond market's still going to be a place to go to get 100% financing. So in our example, where you had a $20 million project, and if the banks are going to do, or senior lenders are going to do 80% of that, that's $16 million. So you're going to have to come up with $4 million on a $20 million project. So the bond market, as I said, is still open, still active. And if you have a lot of liquidity, you have a lot of cash, which means you're going to have more options. So you're going to have more flexibility, more options. Will help your credit rating if you're doing a sizable transaction. Cash is king, even more so now than ever before. So I think you just want to give yourself a little more time to get through the process and consider all your various options that would be available to you. But it's still, the markets are still open. You can still get 100% financing. I think we're all in a bit of a shock of how quickly everything changed in the span of 4 to 6 weeks. But I think as time goes on, there will be a new normal. And, we're not going back to what it was in 2019, but it should get better than where we are now. But I don't think you're taking a risk if you have a lot of cash available. You might have a lot more options in front of you now.
Hey, Mark, this is Kevin. Can I weigh in on that a little bit too?
Please.
So further to Greg's thoughts, and none of this is to suggest that I'm denigrating publicly offered bonds, because they're by far the most flexible financing vehicle, especially for borrowers that need to take down a lot of money. But for this particular situation where there's a high degree of liquidity and the school might have the ability to underwrite a portion of the cost of the project, looking at the alternatives of bank and CDFI financing, I think especially makes sense. And I didn't highlight this when I should have earlier on, but there's very much of a disconnect right now between where rates are for publicly traded bonds and for these various private financing alternatives. It's become especially pronounced. And the reason why that is because bank financing and CDFI financing are largely driven by where treasury yields are, in contrast to publicly traded bonds, which are somewhat driven by treasury yields, but also by their own supply and demand dynamics. So we've got this very widespread to MMD now that is afflicting the pricing of publicly traded bonds, but that's not the case so much with bank and CDFI financing. If you can satisfy their credit standards, you could look forward to much lower cost of financing from those alternatives.
Thanks. So it does sound that the power of preserving cash in these days, or in the days leading up to this, was super important. And Greg, I can't help but think that you might do a Netflix spinoff on Tiger King as Cash is King. Then maybe time for one more question here. Kevin, do you think there are other things that the lenders are going to be looking for in transactions? Are there other things schools should be thinking about besides building up liquidity, or as Laura said, trying to look for other short-term financing available?
Well, I think if you're talking about for existing debt, and further to Laura's comments on that, that's a very provocative area, and we're especially sympathetic to the challenges that charters are facing with respect to their existing debt. It's very, very difficult to get in advance lenders or banks to agree to changes that may require wholesale amendments of documents that, in the case of public bonds, require votes by a majority or perhaps even more than a majority of the outstanding bondholders. And likewise with banks, sometimes we've been successful in getting banks to agree to amend documents in order to avoid violating a covenant in the first instance. So unfortunately, the other alternative may be, if you're not successful in getting support from your lender or bondholders, in going for, I guess we would characterize it as begging for forgiveness rather than permission, which basically means waiting, unfortunately, until the events occurred. That is to say that there's been a violation of the covenant. I do think that banks and the participants in the public markets are going to be pretty lenient under the circumstances, as long as they see the schools, continuing to conduct robust planning of their activities. For upcoming financings, as I mentioned before, they're going to be looking for highly detailed quantitative analysis of all the major drivers of revenues and operations. They're going to be especially focused for schools that are highly dependent on philanthropy, on whether that is sustaining itself. And all those will weigh largely on their underwriting of particular credits.
Great. Well, thanks for that. And I'd like to just highlight on the Q&A slide that everybody's looking at. There is the address for where you can find a recording of this webinar, as well as the slides. The slides are already posted. The webinar will be up in the next 24 hours. If you want to learn more about the response for charter schools to the COVID crisis, you can visit the National Alliance. They have a dedicated website with a slew of resources available there. And if you wanted to stay in touch with the Facilities Center, you can join us. There's a LinkedIn group, it's Public Charter School Facilities Group. And if you go to the facilitiescenter.publiccharters.org, there's a place to sign up. We have a monthly newsletter, as well as a bunch of other resources. Again, we did a webinar on construction, the impact of construction last month, or a few weeks ago. And we'll do a few more webinars, probably one on the short-term markets. That seemed to be a hot topic today. And then I think, even as some people have mentioned, and some people even asked about, what do we think states financing is going to look like here? As budgets come out this summer, we'll probably start doing another series of these same webinars that'll be updated with information. So that's a way to stay in touch. And I'd like to thank Liz Sweeney for moderating the panel. Thank you very much. And our panelists, Laura, Kevin, and Greg. If anybody has further comments about this, you can reach us through the Facility Center's website, and we'll we'll try and stay in touch with everybody. And thank you very much for joining us for today. Please be safe and continue the good fight here to help our kids get a better education. Thank you.
Thank you, Mark.
Thank you.
Thank you.
Thank you.